future accounting standard and also to revise existing standard when there need be. Yes, go ahead if you have a question. Any question? Very good. So another purpose of the conceptual framework is also to assist the International Accounting Standard Board to provide a basis for reducing the number of alternative accounting treatments. What it means is that when you have to treat a particular item on the financial statement, if you don't have a basis for treating that item, which is acceptable by all, then you will see that company A may use a different approach in treating that item. Company B will also use a different approach in treating that item. If that happens, it will not bring about comparability, it will not bring about harmonization. So to reduce these alternative accounting treatments, this conceptual framework assists the International Accounting Standard Board to provide a basis for reducing the number of alternative accounting treatments so that information presented can be comparable and also can be harmonized with another entities. Another purpose of the conceptual framework is to assist national standard setters or the national standard setting bodies in developing national standards. So you have to note them. It's very, very important. We have so many of them. It also assists accountants to apply relevant accounting standards in preparing the financial statements. The same conceptual framework also helps auditors to form an opinion when they have done the audit to state whether the information that is contained on the financial statement show the true and fair view of the state of affairs of the company. The same conceptual framework will also assist the users of financial information and trying to interpret the information as it is contained on the financial statement. So you could see the importance of this conceptual framework. And I have already alluded to that this conceptual framework is going to be our overarching concept or the main backbone for understanding the financial information and also interpreting same in the course of our discussion. Now, when you pick the conceptual framework, what do you see? When you pick the conceptual framework, what do you see? Basically, you see 6 major contents in the conceptual framework. What I'm trying to say is that the conceptual framework has been sectioned into 6 areas. The first part deals with the objective of financial statements. The second part deals with user groups of financial statements. The third part deals with the assumptions that underline the preparation of financial statements. The fourth part talks about the qualitative characteristics of financial statements. The fifth part talks about the elements of financial statements and how the elements of the financial statement are recognized and measured. That is part number 5. And lastly, the conceptual framework deals with capital and capital maintenance, the concept of capital and capital maintenance. So we have different types of capital. And this conceptual framework will deal with that concept of capital and capital maintenance. So let's quickly go through the contents of each section of the conceptual framework. So the number one, if you look at here, it's talking about the objective of financial statement. So we are picking the number one, the objective of financial statement. Why is it that financial statements are normally prepared? The objectives of financial statement or the objectives of financial reporting, they are the same. Now, what the conceptual framework is saying is that the objective of financial reporting is to provide information about, one, the financial position of the business, two, the financial performance of a business, and then also changes in the financial position of business. So the objective of financial reporting is to provide information about the financial position. The financial position is what previously you called the balance sheet. Now we don't say balance sheet, you say financial position. Performance. Performance is what previously you call trading profit and loss account. Now we don't say trading profit and loss account. You say profit, statement of profit or loss and other comprehensive income. Statement of profit or loss and other comprehensive income. You can also say performance statement or income statement, but don't say trading profit and loss account. Then changes in financial position. And these changes in financial position are normally found in the statement of changes in equity, the statement of changes in equity, which we shall look at in the preceding slides. So the objective of financial reporting is to provide information about the financial position, financial performance, and changes in financial position of a business. That is useful to a wide range of users. And the essence is that the users will make that information to make or use the information to make economic decisions, So that is all that I've explained on this slide for you, because I don't want to read verbatim. I have to explain for you to understand what is contained on the slides. If it were left to be reading, I wouldn't be here. So I give you the input of what is contained therein, then you can make your own deductions. Then also, the second part of the conceptual framework talks about the uses. Yes? Yes, go ahead.
I said, my question is, why is it that this time an income statement with other comprehensive income, why should it be, why should that determine the performance of an institution?
Because it shows the results of operation, and the results of operation is the profit. It is just the name that they have changed from trading profit and loss account to profit statement of profit or loss and other comprehensive income. They added the comprehensive income because there are other income which they will have to add, which does not result from the normal operating activities.
Okay.
That makes it the comprehensive income. Are you okay?
Yes, sir.
Very well. So the second part of the conceptual framework talks about the uses of financial statements. And this is not new to you. You all did the foundations of accounting, and you did fundamentals of business as well. So as for the uses of financial statement or financial information, you know them. We have creditors, suppliers, bankers, customers, and the rest. These are what we call the users, the shareholders, prospective investors, the government, trade unions, the general public. These are all groups that have interest in the way the financial statements are prepared. So these are what we call the user groups. So when financial statements are prepared, they have the users in mind. So they prepare it in a way that the users of that financial statement can get information from their system and use it to make economic decisions. And it also informs you that the information that they are going to provide will not be for a particular user. So it depends on the type of user and to know the information requirements of that particular user. What I mean to say is that all the users will not require the same information. So the preparers of the financial statement should prepare it in a way that it will provide information for all users, not to favor one group of users at the disadvantage of another group of users. So if you go through the slides as I have it here, I have different types of users, and you see the information that each user requires. Not all users will require the same type of information. If you are an investor, you want to find out when you invest in the business whether your investment will yield returns for you in the future. If you think that your investment will not yield returns for you, you will not be able to invest, or you will not commit your money into the business. When we have NAM1 came, Piram and the rest, where they were giving higher interest, people were rushing to put their money there. Why? Because they think that they will have more returns on their investment. They will have more returns on their investment. So if you are an investor, your interest of information will be whether when you invest, the business can pay the return on your investment by way of dividend. That will be your information requirement. Somebody who is also an employee will not want that information, but will need a different type of information. So I have put in a slide form here each user and the type of information that the user will require. If you are a management or directors, you require information from the system to find out whether your line of operation has been profitable or not. If you are a supplier, you want to find out whether when you give credit terms to the company and the time matures, they will be able to pay you at the right time. So each user have a specific information needs. If you are an employee, you want to find out whether you have a future with the company, and that when the company makes profit, you will get more pay rises. So these are some of the things that you need to know about the users and the information needs of each user. So I'll put them here for your perusal. Okay, very good. The third part of the conceptual framework, talks about the underlying assumptions of financial statements. You see, when management is preparing a financial statement, they have some assumptions they take into consideration when preparing the financial statement. And basically, the standard talks about, or the conceptual framework talks about two major underlying assumptions. They talk about two major underlying assumptions. And these are the going concern assumption and the accrual assumption. There are two: the going concern assumption and the accrual assumption. The going concern assumption assumes that when a business is operating, it has at the back of their mind that they are going to operate into the foreseeable future without any reason to believe that their activities will be curtailed in the shortest possible term. That is the thrust of the meaning of the going concern basis or concept or assumption. It assumes that the business is going to exist in perpetuity. The business is going to exist in the foreseeable future time. I normally ask my students this question. If you think you will die tomorrow and you have so much money in your pocket, will you use and leave some of the money? You will not. You go about spending all the money in your pocket because you think you will die tomorrow. But because you have at the back of your mind that you will not die tomorrow, but live for a number of years to come, that is why when you spend part of your money, you also leave some for future use. So businesses have the same assumption that they are going to exist into the future. That is why when they prepare their accounts, they have balance carried down and balance brought down. If the business knows that they are going to die tomorrow, will they bring anything down? Never. They will not carry anything down and bring anything down, because the assumption is that they are going to exist in the foreseeable future time. That is why they have balance carried down and balance brought down. Then the actual basis of assumption is also saying that when a transaction is entered into, which have the capacity of bringing revenue to the business, so far as the contract is completed, whether the business receives the money or not, they should take it into consideration. For instance, Company A enters into a contract with Company B to deliver certain items. So far as those items have been delivered, whether they pay or not, Company B have to take that amount into consideration when preparing their financial statement. It is because of this assumption that is why we have owings and prepayments. So whenever you prepare financial statement and you see owings and prepayments, it is because of the accrual basis of assumption. That is why we have prepayments and owings. Please, are you following at all?
Yes, sir.
Yes, sir. You are following. You are following at all.
Yes, sir. We are following.
You are following, eh?
Yeah,
Very
we
good.
are.
Yes,
Yeah,
sir.
right.
Very good. All right. Then let's move on to the fourth part of the conceptual framework. Now, the fourth part of the conceptual framework, talks about the qualitative. Please mute your mic for me. Kindly mute your mic. The fourth part of the conceptual framework talks about the qualitative characteristics of useful financial information. Yes, go ahead. Yes, any question? All right. So the fourth part talks about the qualitative characteristics of useful financial information. You see, for any information to be useful to the user, it must possess certain qualities. It must possess certain qualities. That is what is termed as the qualitative characteristics of useful financial information or accounting information. And this qualitative characteristics is divided into two. We have the fundamental qualitative characteristics. Then we have the enhancing qualitative characteristics. We have the fundamental qualitative characteristics, then enhancing qualitative characteristics. Now, the fundamental qualitative characteristics are relevant, faithful representation, and materiality. Relevance, faithful representation, and materiality. When you say an item of information is relevant, it means that it bears semblance to the financial statement that you have prepared. And for any information to be relevant, it must be reliable. So where information is relevant, then you can rely on it to make an informed decision. Representational faithfulness or faithful representation simply implies that when the preparers of financial statements are preparing the financial statement, they should use all information that is available. They should not be biased, and they should prepare the information in such a way that the information that they use will be complete in all material respects. That is why we have also added materiality as a component of the fundamental qualities of accounting information. What is material is a question of fact, because what is material to company A may be immaterial to company B. An item is not material where it does not influence your decision making. The item becomes material when it is able to influence your decision making. Apart from these fundamental qualities of accounting information, in fact, I must say that principally, the fundamental qualities of accounting information is two. Please note it well. The materiality is complementing the relevance and faithful representation. So the principal fundamental qualities of accounting information are relevance and faithful representation. Relevance and faithful representation. Then we go to the enhancing qualitative characteristics of accounting information. I mean, the enhancing means it plays a complementary role. It plays a complementary role. And we have timeliness, we have verifiability, we have understandability, and also comparability. These are what we term as the enhancing qualitative characteristics of accounting information. What use will an information be to a user when it is not provided at a time that the information is needed? If when the information is needed and you don't have it, it is not relevant again. So for the information to be relevant, it must also be provided at the right time. So timeliness complements relevancy. It is very, very important. Timeliness complements relevancy. Another enhancing qualitative characteristic is verifiability. To be able to verify means to prove from records. So when management is preparing the financial information, they should use those data or records that are easily verifiable from records. And this verifiability also complements objectivity of the information that has been used in preparing the financial statement. The financial statement is prepared for users. What will be the use of the financial statement if the information contained on that financial statement is not understood by the users? So the financial statement must also be prepared to make it more understandable to the user, and that the information from the system can be used to compare companies, that is company A and company B, or compare the performance of company A in different years, maybe 2020 as against 2021. When the company is comparing its performance using different years, I mean the same company, company A, is comparing its performance using different years. For example, comparing 2020 performance with 2021 performance, we say that the company is doing intra-firm comparison. They are doing intra, I-N-T-R-A, hyphen firm, intra-firm comparison. But where the company is comparing their performance with the performance of another company, for instance, you compare the performance of company A as against the performance of company B, then you are doing interfirm comparison. You are doing interfirm comparison. So note what is meant by interfirm comparison, then intra-firm comparison. It is very, very important. So,
now please, can you come again with the intra and then inter-firm comparison? Please, can you?
now when I say inter schools, you know, inter
Yeah.
schools, between one school and
Yeah,
another.
between two companies,
Very good.
when it's inter.
But when I say intra, it's the same company, one company.
Comparing
But you
years.
compare their performance in, let's say, 2019 with the performance of 2020, the same company. Are you okay?
Okay.
Very good. That is the intra, within. Intra is within the same company. So it is intra-firm comparison. I hope it is clear.
Yes, sir.
Very good. So this is the explanation that I've given. So I've explained relevance. I've explained faithful representation. I've explained what is meant by materiality. I've explained comparability, understandability, verifiability, and timeliness. My job is to give you understanding, not to read line by line. I don't like that one. I don't like reading line by line. I have to explain for you to understand. And then at your own time, when you sit down to read, you will appreciate the meaning of the things that I have said earlier. So these are the qualitative characteristics of accounting information, divided into two, the fundamental and the enhancing. I've told you principally, the fundamental is relevance and faithful representation, but it is complemented by materiality. Then we came to the enhancing, where I talk about timeliness, I talk about verifiability, I talk about understandability, then I also talk about comparability. Then the fifth part, I should think so, the fifth part, yeah. The fifth part of the conceptual framework talks about the elements of financial statement and how these elements are recognized and measured on the financial statement. When you say you are recognizing an item on the financial statement, it means you are sending that item to the financial statement. That's what we call recognizing. You are representing that item on the financial statement. It is called recognition. When you are recognizing the item on the financial statement, at what amount are you going to recognize it? And that is the measurement. And what is the measurement? So we are going to look at the elements of the financial statements and how these elements are recognized and measured on the financial statement. The question is, what are the financial statements? I've been mentioning financial statement, financial statement, financial statement. There are 5 major financial statements or financial reports. There are 5 major financial statements or financial reports. We have the statement of financial position, which I told you earlier on, it's called the balance sheet. We have the statement of profit or loss and other comprehensive income, which previously it is called the trading profit and loss account. We have statement of changes in equity. We have statement of cash flows. And then we have the additional notes that accompany the financial statement, which has been prepared. So there are 5 major financial statements. And when you go into the financial statement, each financial statement have elements. Each financial statement have elements. You did commas, and when you went to the sets of set A, set B, you say they have members or elements. So when you pick each financial statement, they have elements. For instance, when you pick the statement of financial position, which previously we called the balance sheet, we have elements or members of that financial statement. We have assets, we have liabilities, we have equity. They are found in the financial position statement. So the elements of the financial position are assets, liabilities, and equity. When you go to the statement of profit or loss and the other comprehensive income, it also have elements. And the elements are, they have what is called revenue, they have expenses, they have gains, they have losses. When you go to the statement of changes in equity, they have retained earnings, they have what you call surpluses, either income surplus or capital surplus, they have revaluation surplus, and the less. Then when you go to the cash flow statement, we have investing activities, we have financing activities, then we have operating activities, and then have the notes that normally accompany the financial statements. So this is what you see. The elements of the financial statements you see on the slide. So what you see there is the elements of the statement of financial position, which have assets, liabilities, and equity. The equity is capital. It is not today that I'm going to define assets for you. Assets are resources which is controlled by an entity as a result of past events from which future economic benefits are expected to flow to the entity. That is an asset. You have a liability and you have equity. You learn this one in level 100 when you were dealing with foundations of accounting. So you know what's an asset, you know what's a liability, and you know what's an equity. These are the three elements on the statement of financial position. Then you go to the income statement or the statement of profit or loss and the other comprehensive income. You see the word income. In fact, when I use the word income, it means revenue plus gains. Revenue plus gains. That is what constitutes income. Revenue is the money you obtain from the normal operating activities of the business. Gains are the other revenues or receipts you get apart from the normal operating activity. For instance, you sell an asset at a profit. It's a gain. And that gain is not part of your normal operating activity. So when I add the gain to the revenue, it gives me income for the business. So income comprises revenue and gains. Then we also have expenses. So in the examination, when they ask you the elements of financial statement, see, when they say the elements of financial statement, they have put all the financial statement together. The elements of the financial statement. In that sense, we have 5 elements. We have 5 elements. We have assets, we have liabilities, we have equity, we have income, and we have expenses. I hope it is clear. Is that clear? Is that clear, please?
Yes, sir.
Yes, sir.
Very good. So I've explained assets here for you. Assets, you can divide them basically into 2. You can have non-current assets. First, you call them fixed assets. This time, you don't have fixed assets. You say non-current assets and current assets. So basically, we can divide the assets into 2. Basically, I say basically, because there are other divisions we can have. Basically, we can divide the assets into non-current assets and the current assets. When you go to the liabilities, we can also divide the liabilities into non-current liabilities and current liabilities. The question, therefore, is how do we recognize assets on the financial statement? How do we recognize assets on the financial statement? It's very simple. An asset can only be recognized on the financial statement when it is probable that future economic benefits in that asset will flow to the entity. That's all. So an asset can be recognized on the financial statement when it becomes certain or probable that the future economic benefit that is associated with the asset will flow to the entity. In that sense, that asset can be recognized on the financial statement. I've talked about liabilities, which is current and non-current liabilities. Don't go and say long-term liabilities. Now we don't say long-term liabilities. We have non-current liabilities and current liabilities, non-current liabilities and current liabilities. And then also, I've given you examples of these liabilities, so you can see them there. Okay. How do we recognize liability? Liability is also recognized when it becomes certain that economic resources will flow out of the entity. You see, the asset, I define it to be flow into the entity. So you also recognize the liability where it becomes certain that economic benefit will flow out of the entity. Then you have to recognize the liability. You have to recognize the liability. So that is that. Then we also have equity. You know, equity is the residual interest between the assets and the liabilities. Equity is the residual interest between the assets and the liabilities. That is to say that assets minus liabilities will give you your equity. And that is what you learned in level 100 about the accounting equation. Assets equals equity plus liabilities. So if you want equity, then you shift the liability to your left-hand side, and it becomes assets minus liabilities. That will give you your equity. Now, equity is what first you call capital. So now we say it is equity. Equity. Okay. So look at what I have stated here. It's very, very instructive. Criteria for recognizing the elements of financial statement. Criteria or recognition criteria of the elements of financial statement. 1, it must be probable that future economic benefits that is associated with the item will either flow into the entity or flow out of the entity. And the cost of that item can be measured reliably. Because if you can measure the cost reliably, at what amount are you going to recognize the item on the financial statement? So the item's cost should be able to be measured reliably. I must say that all that I'm telling you is in your model. All that I'm saying is in your model. So apart from the slides that I'll be sharing with you, you can also get information on the model. And I'll also share with you the ICA Ghana manual on financial reporting, which will serve as the mother reference material, for your course, both financial reporting 1 and financial reporting 2. It is also useful in level 300 and also level 400. So I'll share that one also with you. If you don't like it too, you can let me know that you don't want it, so I will stop sharing that one with you.
So we really want it. We really want it.
Okay, that's fine. I'll share that.
Yeah, we really want
There's no way a student will say we don't need it. You always say you need it.
Yes.
Even when you go to where they make the photocopy and your colleague is making a photocopy, you don't even know the content of what is making a photocopy. You just say, oh, Charlie, I have a why. You don't even know the content. Say, oh, yeah, I have a You see? Very good. So I have also talked about how items are measured. To measure an item means to determine the monetary value of the item that you have to show on the financial statement. That is why one of the criteria to recognizing assets is that the cost must be able to be measured reliably. If you cannot measure the cost reliably, at what amount are you going to recognize the item on the financial statement? So measurement is the process of determining the monetary amount at which the elements of the financial statement are to be recognized. The process of determining the monetary amount at which the items that you have shown on the financial statement are to be recognized is very important. How do we measure them? How do we measure the elements on the financial statement? We can measure them using the historical cost. The historical cost is the cost that the item was originally bought or the expenses that was originally incurred. We call them historical cost. That is cost which can be verifiable from the records. That is what we call historical costs. We also have another measurement called current cost. Now, another name for the current cost can all be the amount that you need to pay now, current, now, if you want to replace the item in question, or if you want to settle your liability. At what amount are we going to pay to settle the liability? That is what is called the current cost. We have the realizable value, or the deprival value, or the settlement value. That is the carrying amount of the asset. When I say the carrying amount of the asset, is that if today we want to sell the asset, what amount are we going to realize? That's what we call realizable value or settlement value. Or today, if you want to pay our liability, at what amount are we going to settle the liability? Then we also have the present value. In fact, the present value is normally used in the future. If you have a liability to settle in the future, or if you have a cash to be received in the future, you will bring it into present terms by discounting that cash flows. You discount them into present terms by the help of discount factors. So when you discount any future cash flows, you get what is called a present value. You do it in quantitative methods. Now that you are doing quantity, I think when you go to unit 4 or so, either unit 4 or 5, you will see financial mathematics there, where you do present values, future values of annuities, and the rest. So you get to know these present values. Then also the last one, the last item on the conceptual framework is the concept of capital and capital maintenance. So this concept of capital and capital maintenance, we are talking about how the economists view capital and how the accountants also view capital. As an accountant, they view capital as the excess of your income as against your expenses, or properly put, the excess of assets and over liabilities. But the economists will view capital in a different way altogether. That is why we have divided the concept of capital and capital maintenance into two. So we have what we term as financial capital maintenance, and physical capital maintenance. Financial capital maintenance and physical capital maintenance. So when we say financial capital maintenance, we are talking about profits. So far as the business is making profit, always the capital of the business remains intact. The moment the business makes losses, capital will reduce. So the financial capital maintenance deals with profit and how to ascertain profit. So you can easily look at the capital at the beginning of the business and the capital at the end of the business. Assuming you started business with 10,000, that's the opening capital. At the end of the business, you have 12,000. It tells you that capital has increased by 2,000. What is that 2,000? It is profit. So the financial capital maintenance is saying that so far as the business makes profit, capital is always maintained. But when we look at the physical capital maintenance, when you see it here on this slide, then they are talking about where the physical productive capacity of the entity at the beginning and at the end of the period. Here they don't consider capital. They look at physical productive capacity at the beginning and physical productive capacity at the end. So if the physical productive capacity at the end exceeds the physical productive at the beginning, then we say that capital has been maintained. And that one is physical capital maintenance. Physical capital maintenance. So when you go and you get this slide, you will get a vivid description of what is meant by financial capital maintenance and physical capital maintenance. Very, very instructive. Why should we rely on the conceptual framework? Why should businesses rely? So the relevance of the conceptual framework. Why is the conceptual framework so relevant? Why is the conceptual framework so relevant? And I've told you, it assessed, we said it earlier on, it assessed the International Accounting Standard Board to set future standards and to review existing standards. I've said that one also. Then it will also assist national standard setters or national standard setting bodies to develop national standards. It will also help in the preparation and presentation of financial statements. So you get the relevance of the conceptual framework here in. And then also, finally, it enables users of financial statements to interpret the information that is contained in the financial statements and see whether indeed, when they were preparing the financial statements, they complied with the International Financial Reporting Standard. They complied with the International Financial Reporting Standard. Then this slide talks about the importance of a conceptual framework. It's very, very important. The importance of the conceptual framework. It gives us guidance. It provides a point of reference. It helps us to be less prescriptive because it will reduce the amount of subjectivity in the preparation of the financial statement. It also addresses the underlying assumptions when preparing financial statements. So all of these things are there. We have about 8 of them. It assists users of financial statements. It assists auditors in the performance of their duties. And then the conceptual framework can also assist standard setters to develop specific accounting standards. So about 8 importance of the conceptual framework is available for your consumption. Then the limitations of the conceptual framework. The limitations of the conceptual framework. Now, what you are saying is that we have different types of uses of the financial statement. So the financial statement, which is intended for a variety of uses, and it is not certain that a single conceptual framework can provide all the information that is needed by the various users of the financial statements. So we have about 3 limitations of the conceptual framework. One thing that you have to also note is that the conceptual framework is not a standard. It does not replace the standard. It just gives us a guidelines. So the conceptual framework is not a standard. So you have to also note that one. Now, I want to look at the ethical framework of financial reporting. Accountants are guided by ethics of their profession. So when preparing the financial statements, accountants must adhere to those ethics. Ethics means distinguishing what is right from what is not right, what is good from what is bad. So what is ethical is good, what is non-ethical is bad. So this ethical framework provides ethic guidelines to all accountants in the discharge of their duties. Basically, we have 5 ethics or ethical principles. Basically, we have 5 ethical principles that every accountant is enjoined by their profession to follow religiously in the performance of their duties. And these are 1. Not this one. These are, when you follow ethics, you become very honest, you keep this, but that's not the principle. These are the principles, the ethical principles. Let me see what I will get it here for you. Ethical principles. Oh, where are they? Hey, where have you gone to? The ethical principles. Maybe it's in the sentence form. So let me look out for. Yes. Okay. Look at the last bit of this statement. The Code of Ethical Principles for Professional Accountants. The last bit of this slide. The Code of Ethical Principles for Professional Accountants are enshrined in the International Federation of Accountants Code of Ethics, which comprises 1. So these are the ethical principles. 1, integrity. 2, objectivity. 3, professional competence and due care is 1. Professional competence and due care is 1. 4, confidentiality. And 5, professional behavior. So these are 5 ethical principles that accountants should always be guided when performing their duties. Being integrity means being honest and straightforward. Being honest, truthful, and straightforward in the performance of their duties. Being objective means not biased, factual in the performance of their duties. Professional competence and due care means that the accountant must have the needed qualification befitting the accounting status and possess the necessary skills that they can perform the work. Confidentiality means that in the performance of the duties of the accountant, they may come across various information. They have to be very confidential, not to divulge or disclose information which they do not have the authority to disclose to other interested parties. They should not engage in what we term as espionage, doing spying for another company. Espionage. 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 Being a spy. You spy for another company. You have to maintain confidentiality. If you divulge information for which you do not have authority, you can be held accountable by your employers. And then as an accountant, in the performance of the duty, you have to exercise due professional behavior. You should not bring the name of your profession into disrepute. You should not do anything that will cause a slur in the name of the profession that you belong to. Else, sanctions will await you. You can be suspended. You can be dismissed from the association if it is found that your professional behavior is unbecoming of an accountant. Earlier on, we did mention that one of the objectives of the International Accounting Standard Board is that they set standards. They set standards. Now, if this International Accounting Standard Board are going to set standards, what will be the process that they have to follow to set up the standard? We have 5 processes that are normally followed by the International Accounting Standard Board in the setting of accounting standards. So these are the process. When you say something is a process, it's sequential. You cannot jump from 1 and go to 2. You have to follow in that order. From 1, you go to 2, you go to 3, and you go to 4 in that order. So the first process in setting up a standard is that you have to have an agenda. That's number 1, agenda. Setting the agenda. The agenda means what you intend to do, the work plan, the due process you have to follow. What is before you is what is termed as an agenda. So if you don't have an agenda, it will be very difficult to say you are setting a standard. What standard are you setting? So you must have an agenda. So the agenda that you want to research into or set a standard for should be something that will be beneficial to the users. Plan for the project. When you say you are planning for the project, you select a team of professionals that will come together to put that idea into concrete projects. So you plan for the project. Step 3 is to develop what we normally call discussion paper. It means you develop a paper, consult other people in the public, and also incorporate their views in the promulgation process of the standard. So step 3 says develop and publish discussion paper, including public consultation. Don't confuse step 3 with 4. Step 4 will also say develop and publish an exposure draft. Exposure draft is first draft. See, when you are writing something, you say you make a draft before you put it into final writing. So the 3 is saying develop and publish the discussion paper, including public consultation. 4 will also say develop and publish the exposure drafts, also including public consultation. And 5 is where you develop and publish the standard. Now, when the standard is published, it doesn't mean that they should start using the standard the same year that it is published. It is the standard setters that will determine when the standard that has been published will come into force. So not that as soon as the standard is published, it will come into force. No, it doesn't work that way. So normally they will give you a procedure that the standard will have to be issued. So when I add that one to give you 6 processes that must be followed in setting up a standard. So that's the end of my slide here. I want to do another thing for you before the time sets up. I want to look at IAS 1. The IAS 1 talks about the preparation and presentation of financial statements. So I'll stop sharing this one and make that one available. IAS 1. Let me see. IAS 1. Let me show that slide quickly, and we shall go through it and close. Let me see if I can present that one. Just a minute, please. Please, can you see the slides? IAS 1.
Yes, sir.
Yes.
Not all of us.
My friend from NG, can you see the slides?
Yes, I can see my networks are very bad. So I wish we can get the recording even after.
The code is recording, so they will send it to you.
Okay,
they will
sir.
place it on your platform. They normally record, so they will place it on your platform.
I can see it being recorded, so but yes. I can see the slides. Yeah.
Yeah. Code is recording. They will make it available to you. So no cause for alarm. Are you okay?
Okay, sir.
Very good. So we are looking at IAS 1. IAS 1 talks about presentation of financial statement, how financial statements should be prepared. I pick IAS 1 now because it fits into what we have done already. So you will not find problem understanding what is contained in IAS 1. Now, the IAS 1 sets out the overall requirements for the presentation of general purpose financial statement. It will show us the guidelines and the structure that we have to follow to present financial statement. That is what is contained in IAS 1. So it applies to the preparation and presentation of general purpose financial statements. And what is the structure? In preparing the general purpose financial statement, you have to be mindful of these provisions. You have to be mindful of these provisions that all items are fairly presented on the financial statement and they comply with the requirements of the International Financial Reporting Standard. And that there should be explicit and unreserved statement of compliance in the notes. You cannot rectify inappropriate accounting policies. I mean, when you use inappropriate accounting policy, you cannot rectify it. So always know the type of policy that you want to adopt in the preparation of your financial statements. And when you adopt a particular policy, you cannot depart from that policy unless it becomes very difficult or impracticable to apply that policy. quite difficult or impracticable to apply that policy. And then also, you have to be conversant with the various accounting concepts, the going concern that I talked about earlier, the accrual concept, consistency concept, materiality and aggregation. When I say materiality and aggregation, it means can we aggregate like items, or we have to show them individually, or can we offset items? Let's say we have rent received 10, rent payable 5. Can we offset it? The standard will tell you whether you can set it off or you cannot set them off. So there are general provisions that you have to arm yourselves with when preparing and presenting financial information under IAS 1. So let's take the first one. When you pick IAS 1, these are the financial statements that we have. And you see, I mentioned this one when we were dealing with the conceptual framework. I mentioned statement of financial position. I mentioned the income statement or the statement of comprehensive income. I mentioned statement of changes in equity. I mentioned statement of cash flows. Then I also mentioned the explanatory notes. And then the statement, this one is, they have added another one. What it means is that if we are preparing financial statement and there's a new standard which has come into force and we want to transition from the old to the new, how do we go about it? So these are the financial statements which we shall be preparing under IAS number 1. The nature and structure of IAS 1. Whenever you are preparing a financial statement, the following must be borne in mind. The following must be borne in mind. The name of the reporting entity. That's why at times we write the ABC Company Limited statement of profit or loss. So the name of the reporting entity or the business is very, very important. You have to write it. The name of the reporting entity. And then whether the statement that you are preparing is for a single company or a group of companies. Whether the financial statement is for a single company or a group of companies. You have to show that one also. The period that the financial statement covers. That's why now you say for the period ended, you add the date there. So the period that the financial statement covers must also be shown. The presentation currency, either in cedis, dollars, or pounds, must also be shown. And if figures are rounded up on the financial statement, you have to tell the user the level of rounding up. Maybe to 1 decimal place, 2 decimal place, you have to tell the user. It's very, very important. So those who prepare financial statements without writing the heading, you are in trouble. You have to write the name of the reporting entity. And you have to also write trading profit and loss account, or sorry, the statement of profit or loss account. If it's for a group, you say a group or consolidated. Once a group, you say consolidated statement of profit or loss. If it's a single company, you just write the name of the company. That's very, very important. So this is just repetition.
Hello, sir.
Yes.
So please, where this is whether the financial statements are for single or group. So you are preparing a financial statement for a company that has branches
that have subsidiaries. Okay.
I mean a financial institution.
If there are branches, it is one. Okay. It's not a different company.
So if now you can't say consolidated.
No, not at all.
Okay.
If you have subsidiaries, I get it. Let's say company A has acquired shares in company B.
Okay.
They become a group. But if you have a branches, that is not a group. Are you okay?
Yes, sir.
Very good. Then the structure of the statement of financial position, which I told you earlier. We have assets, we have liability, and we have what? Equity. You have to show the current and the non-current. And then when you go to the liability, you have to also show the, I'll come back. When you go to the liability, you have to show the current and also the non-current. And you have to know some examples of current assets, which for now, I presume you know. At least you know receivables. I know you know prepayments. You know cash and cash equivalents. You know, let's say, short-term investments. These are current assets. Then the non-current assets, you know them. We have the PP, property, plant, and equipment. You have long-term investments and the rest. Then you go to liabilities also. You separate them into current liabilities and then the non-current liabilities. Then when you go to the statement of comprehensive income, you know it comprises of income and expenses. So you show income on one side, you show your expenses on the other side. I'll give you the format for you to see pretty shortly. Then when you go to statement of changes in equity, I think I have the format that I will show you. Very good. So this is how you present the statement of financial position. Look at how it has been arranged. So when you go to the asset side, you have the non-current assets. I've given you examples. There are the current assets. I've given you examples. Now you don't say stock, you say inventories. Don't go and say stock, you say inventory, inventory. Don't go and say debtors. You don't say debtors again. You say receivables, receivables. Don't go and say creditors again. You say payables, payables. So these are some of the new things that you need to know. All right. So this is the structure of the statement of financial position. Then we also have the statement, the structure of the statement of comprehensive income. You have revenue, cost of sales, you get your gross profit, you add your other income, you subtract distribution costs, administration costs, profit from operation, in that order, as we normally know. Before you come to the other comprehensive income, gains and losses from when you revalue your assets or sell your assets, and then also gains and losses on fair value to other comprehensive income. All these things will be practicalized in financial reporting 2. You can even get practical questions in financial reporting 1 by employing IAS 1. Try and remind me by WhatsApp tomorrow when I get to the office. I'll get you a sample question on IAS 1 that you can practice on to prepare your income statement, to prepare your statement of financial position in consonance with IAS 1. In consonance with IAS 1. So the course rep remind me tomorrow by WhatsApp. Don't call me. I'll be teaching tomorrow. It's a very busy day for me. I'll be teaching tomorrow. So when you send WhatsApp, I'll see and I'll respond to it. Tomorrow, when I get to the office, I'll also send the slides to you, and you can use them at your own time. Then when you go to the statement of changes in equity, you have the SC. SC means stated capital. You have SD. SD means share deals, retain or revenue reserve, retain earnings. So we shall prepare practical things. You see how all these things are going. But for now, you see them in abstract form. You see them in abstract form. But when we start preparing financial statements, you all appreciate what I am trying to put across. These are the relevant standards that we shall be employing in the preparation of all items that you have in level 200. You remember that now we are talking about IAS 1. We shall also do IAS 16. We shall do IAS IFRS number 15. We shall also do IAS 32, IAS 36, IAS 38, IAS 40, and then IFRS number 13. All that I've mentioned, we'll do it in financial reporting 1. The rest will be done in financial reporting 2. So by the time you finish second semester, you must have done all these standards that you see on the slides. So you have a lot to learn, and you will go through them successfully. I think that's about all under my IAS number 1. Please, when you go home, I beg of you, read IFRS number 13. That is the most important thing left. That's the most important thing left. IFRS number 13, which talks about fair value measurement. Read. I'll ask you questions when we meet next week. Before I start my lecture, I'll ask you questions. I will ask you questions before I start my lecture next week. So I thank you very much for joining today. The lesson has been very, very fruitful. I can see about 40 participants joining. And if it continues like this, I hope we will be able to go through it successfully. So I thank you very much. I will see you next week. Thank you. Yes, go ahead.
So sharing the recordings.
We should read
No,
IFRS
the recording
13,
is
fair
code.
measurement.
It's code that will put it. Code will send it to you. It's not with me. Code will send it to your platform. Are you okay?
Okay.
Yes.
All right. Thank you.
So we should remind them to do that to our platform so that we can.
You will get it. Don't worry. You will get it. Hello.
And
You
the
will get it.
slides.
Yes. You will get a slide. I'll put it on the platform.
Okay.
Tomorrow when I get to the office, I'll put the slides on the platform.
Okay,
Party. Yes, party. I saw your hand.
Sir, please. So our meeting days will be Monday 7. Sundays are off.
Yes, Sundays are off, please. Sundays are off.
Okay.
All right.
Now we
So I'll see you next week. I'll see you next week.
Okay, sir.
Thank you.
Have a good evening.
Good evening.